Auto insurance initiatives. Motor vehicles account for more than 25% of all US greenhouse gas emissions. Insurance policies such as pay as you drive, which factors mileage driven into the price of insurance, and hybrid car discounts could reduce that amount by more than 10% if broadly implemented. According to CARES, a network of companies concerned about global warming, a study by the bookings institutions suggested that if drivers paid by the mile, driving would drop by about 8%. There are two ways to reduce the greenhouse gas emissions associated with driving. One is to encourage people to purchase vehicles that emit less carbon dioxide into the environment and get more miles per gallon of gasoline. A number of companies offer discounts to people who drive hybrid vehicles. Some believe that people who are socially responsible are also more responsible behind the wheel. The other way is to reward people for driving fewer miles, known as pay as you drive (PAYD) auto insurance. Several insurers have developed technology-based discount programs that provide financial incentives to drive fewer miles. Mileage information comes from a special device. In some, it is linked to the car's odometer, and in others, it is a wireless sensor that can monitor speed as well as mileage. These programs are offered in a growing number of states. In addition, California and several other states are encouraging the development of PAYD programs. Insurers are helping to promote sustainable building practices by offering green homeowners and commercial property policies. In addition, they are responding to the growing demand for assistance with energy and emissions reduction products with risk management services that address global warming. Green building insurance coverage. Increasingly, homeowners at the leading edge of the environmental sustainability movement are generating their own geothermal, solar or wind power and selling any surplus energy back to the local power grid. Several insurers are supporting this trend by offering a homeowners policy that covers both the income lost when there is a power outage from a covered peril and the extra expense to the homeowner of buying electricity from another source. Policies generally cover the cost of getting back online, such as utility charges for inspection and reconnection. Some insurers offer homeowners insurance policies that, in the event of a fire or other disaster, allow policyholders to rebuild to environmentally responsible green standards even if they had not purchased such a policy or originally. Green standards parts of the sustainability movement include energy conservation benchmarks and the use of renewable construction materials. The Green Building Council introduced its Leadership in Energy and Environmental Design (LEED) certification program in 2001. According to cares building account for more than one-third of greenhouse gas emissions, and green building practices can reduce energy use and emissions by more than 50%. With green commercial building construction expected to rise significantly over the next few years, a growing number of insurers are offering green commercial property insurance policies and endorsements, some of which are directed at specific segment of the business community, such as manufacturers. The first green commercial policy was introduced in 2006. In general, the policy allows building owners to replace damaged buildings whether or not they are already certified green with green alternative, including energy efficient electrical equipment and interior lighting, water conserving plumbing, and non-toxic and low odor paints and carpenting. They also may pay for an engineering inspection of heating, ventilation, air conditioning system, building recertification fees, the replacement of vegetative or plant covered roofs, and debris recycling. Some cover the income lost and costs incurred when alternative energy generating equipment is damaged. Credit scoring. The goal of every insurance company is to correlate rates for insurance policies as closely as possible with the actual cost of claims. If insurers set rates too high, they will lose market share to competitors who have more accurately matched rates to expected cost. If they set rates too low, they will lose money. This continuous search for accuracy is good for consumers as well as insurance companies. The majority of consumers benefit because they are not subsidizing people who are worse insurance risk. People who are more likely to file claims than they are. The computerization of data has brought more accuracy, speed, and efficiency to business of all kinds. In the insurance arena, credit information has been used for decades to help underwriters decide whether to accept or reject applications for insurance. New advances in information technology have led to the developments of insurance scores, which enable insurers to better assess the risk of future claims. An insurance source is a numerical ranking based on a person's credit history. Actual studies show that how a person manages his or her financial affairs, which is what an insurance score indicates, is a good predictor of insurance claims. Insurance scores are used to help insurance differentiate between lower and higher insurance risk and thus charge a premium equal to her risk. They are amusing. Statistically, people who have a more insurance score are more likely to file a claim. Insurance score do not include data, no race or income, because insurers do not collect this information from applicants for insurance. The poor economy has not had a Negative impact on credit scores. According to an April 2009 Property Casualty Insurance of America (PCI) release, the recent economic downturn did not have the negative effect on credit score that some people predicted. Major consumer credit reporting agencies such as Fair Isaac and TransUnion have reported that average score remains steady or have improved, possibly because consumers are saving more and paying off debt. Despite the economy and credit crisis, no state has made regularity a change to insurance use of insurance scores PCI notes. Federal activities. The Federal Trade Commission (FTC) has asked 9 of the largest homeowners insurance companies to provide information that it says will allow it to determine how consumer credit data are used by the companies in underwriting and rate setting. The Fair and Accurate Credit Transaction Act, passed in 2003, directed the FACT to consult with the Office of Fair Housing and Equal Opportunity on how the use of credit information may affect the availability and affordability of property casualty insurance, whether the use of certain factors by credit scoring system could have a disparate impact on minorities, and if so, whether the computer models used could be modified to produce comparable result with less negative impact. The study is expected to be finalized sometime 2010. In a similar study, the FTC found that auto insurance use of insurance credit scores leads to more accurate underwriting of auto insurance policy, in that there is a correlation between insurance scores and the likelihood of filing an insurance claim. The FTC report credit-based insurance score impacts on consumers of automobile insurance, released in July 2007, also stated that credit score cannot easily be used as a proxy for race and ethnic origin. In other words, credit scoring predicted risk for members of minority groups in much the same way that it predicted risk for members of non-minority groups. The Fair and Accurate Credits Transaction Act of 2003 directed the FTC to address the issue of whether the use of credit had a disparate impact on the availability and affordability of insurance of minorities based on a pool of consumers. The General Accountability Office has recommended that the Treasury and FTC take steps to improve consumers' understanding of credit scoring and how credit histories are used, targeting in particular those with less education and less expensive experience in obtaining credit. The Federal Reserve also studied the use of credit scoring, also looking at credit scoring to quantify risk posed by a borrower rather than an application for insurance or a policyholder. The Federal Reserve said in a report issued at the end of August 2007 that credit scores were predictive of credit risk and were not proxies or substitutes for race, ethnicity, or gender, underscoring the FTC study.